So Andrew, it's been kind of an interesting year to manage some money. I mean,
to say the least.
We started off with a little bit of a dip, a little bit of a downturn, intra-year decline here, right? In kind of that February, March, even parts of April. But that being said, the markets have completely rebounded. It's been a wonderful market to make some money in, and even when you start looking at the summer months in September that historically have some pullback, we also didn't see that. And so as you start to think about what we've done as an investment advisor committee and kind of navigating through that, and by the way, I'm very proud of how we've managed that. Where's your head, and where do you think our committee's head is as we go into the fourth quarter and end this year, and where do you think we're going to be?
You hit the nail on the head when you said it's been an extremely volatile year. So I'm just going to use GDP figures. When you look at Q1, GDP was terrible, right? You look at at that point in time, the forward projections for what GDP was going to be for the year, a lot of people were calling for recession. And then and then Q2 hit, and it jumped from kind of recessionary territories up to 3+%, right? And then Q3 kind of came back down to the mean. And so it was okay, not good, not terrible, just okay. What that did to the markets, though, you saw, if you want to take the S&P 500 index, you saw, what it did. Now, I feel like we navigated that extremely well. I believe, we constantly talk about using volatility as an asset class. We were able to do that this year.
Absolutely.
But as your real question is, as we look forward, you hit on something that we didn't see, the traditional market pullback that we get kind of September. We did see it a little bit at the start of this October.
A little bit. I wonder if that was kind of
not as much. Now, I do think we were starting to have it, and then the Fed came out and lowered interest rates. And that changed the historical bad month of September, October. All of that being said, I think that the banks are already starting to report third quarter earnings. The banks are reporting really well, right? That's generally a pretty good sign.
Indicator.
It's a good indicator. Historically, the fourth quarter is really good. I think as we look at this year, if we were to end the year where we're at right now from a return standpoint, I think most people would be really happy. So from an investment advisory standpoint, we're looking at it as preservation of existing return, right? How do we maintain what we have? And then is there opportunities for tax loss harvesting and things like that towards the end of the year? You never know where markets are going to go. I think the fourth quarter has probably a sideways to slightly up opportunity. I think a lot of it will depend on this reporting season. It's really interesting because companies have continued to perform really well this year, but people have just not felt the same way. I think inflation has a little bit to do with that.
Tariffs.
I think the headline news, I think inflation. But man, Craig, if you take a step back and you go back to some of these we were doing at the beginning of the year, there was so much unknown risk that we were thinking about from a geopolitical standpoint. We had all of these wars happening. We had things going across the globe.
Didn't know what Fed was going to do. All sorts.
It was a crazy, hectic time. We've navigated that, and to a lot of aspects, we've been able to mitigate a lot of the geopolitical risks that have happened. So we have to give a lot of credit for what's happened on that. I think the fourth quarter traditionally is a strong quarter. We've had a lot of rebounds already this year. We've been led by tech. Tech led us down in Q1 brought us right back up. We are seeing a little bit of broadening in the market. I think the way that we look at it is just companies with strong balance sheets, companies with really good cash flow that are not extremely overvalued. But I'm going to be honest, if you're not in some of the tech, you're missing out on return.
And I think like we're always positioning, we're nimble, we're flexible. We won't always get it perfect, right? I don't have a crystal ball, you don't either. But what I can tell you is, as cautiously optimistic as we are, if something new changes, we'll be dynamic in the way that we handle it.
100%.
And I think you're right. I'm proud of the team, and I'm proud of how I know we're going to finish the year.
And I think you used a term that's really important. I would agree with that. We're cautiously optimistic as things go out, but we're very closely watching the earnings reports on Q3. We're watching consumer savings rate, credit delinquencies. The labor market, all the things that you're constantly looking at to see what the strength of the economy is. But I think we have the make out to have a really good year.
I agree. If you'd like to learn more, check us out on the web at prevailiws.com or call one of our advisors today.